Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LiveRamp Holdings, Inc. quarterly report. LiveRamp Holdings, Inc. offers a range of businesses and services through its data collaboration platform. At the core of its offerings are people-based marketing solutions that enable organizations to unify customer and prospect data while protecting consumer privacy. These solutions include data collaboration, activation, measurement and analytics, identity, and a data marketplace. The company's platform supports various industry verticals, including financial, insurance and investment services, retail, automotive, telecommunications, technology, consumer packaged goods, media, healthcare, travel and hospitality, entertainment, and nonprofit. Its clients span across enterprise marketers, agencies, marketing technology providers, publishers, and data providers. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to significantly drop. The stock price of LiveRamp Holdings, Inc. has likely dropped due to various market and economic factors. One possible reason is a decline in revenue or profitability, which can be caused by decreased demand for the company's products or services, increased competition, or inefficient operations. Additionally, changes in industry trends or regulatory requirements may also impact the company's performance. Another potential cause of a stock price drop is poor management decisions or leadership issues. This could include strategic mistakes, such as overexpansion or underinvestment in key areas, or governance problems that erode investor confidence. Furthermore, external factors like economic downturns, industry disruptions, or global events can also negatively impact a company's stock price. In some cases, a stock price drop may be due to internal issues, such as financial mismanagement, accounting scandals, or other corporate malfeasance. This can lead to a loss of investor trust and confidence in the company's ability to manage its finances effectively. LiveRamp Holdings, Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. LiveRamp Holdings, Inc. trades at a higher price-to-earnings ratio of 39 times, and a lower price-to-book ratio of 1.56 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 25% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. Subscription revenue growth is a significant contributor, driven by the increasing adoption of subscription-based models across various industries. Additionally, marketplace and other revenue streams have also seen substantial growth, indicating a diversification of revenue sources. Another crucial factor is the expansion of partnerships and ecosystems, which enables companies to tap into new markets and customer segments. Data collaboration platforms and third-party data providers have also played a vital role in driving revenue growth. Furthermore, revenue-sharing arrangements with data sellers through the data marketplace and transactional usage-based arrangements with publishers and addressable TV providers have contributed to the company's revenue growth. The company has also seen significant growth in its subscription net retention and annualized recurring revenue, indicating a strong customer base and predictable revenue streams. Remaining performance obligations have also increased by 23%, suggesting a growing pipeline of future revenue opportunities. In contrast, there are no explicitly mentioned primary drivers of revenue decline. However, potential risks and challenges that could impact revenue growth include acquired businesses' integration challenges, lengthening sales cycles, failure to keep up with rapidly changing technology practices, and short-term contracts affecting revenue predictability. The net income of the company experienced significant growth between 2024 and 2025. In Q3 2025, the net income increased by 256% compared to the same period in 2024, reaching $39,873. This trend continued throughout the year, with a YTD increase of 1,376% in 2025 compared to 2024, resulting in a net income of $75,040. The profit margins also showed notable changes during this period. The gross profit margin remained stable at 72% for both Q3 and YTD periods in 2025, indicating no significant change from the previous year. However, the operating profit margin saw substantial growth, increasing by 161% in Q3 2025 and 267% in YTD 2025 compared to the same periods in 2024. Despite these changes, there is no specific reason provided for the increase in net income and profit margins. The data suggests that the company's financial performance improved significantly between 2024 and 2025, but the underlying causes of this improvement are not specified. The company is indeed generating positive operating cash flow, a crucial indicator of its financial health. The data from the past 2 years shows a steady increase in net cash provided by operating activities. For the 9 months ended December 31, 2025, the company reported $108.9 million in net cash provided by operating activities, a significant improvement from the previous year's figure of $91.4 million. This upward trend suggests that the company is effectively managing its operations and generating sufficient cash to meet its financial obligations. The company's debt level has remained relatively stable, with no significant changes observed. However, there are some fluctuations in its current liabilities and other liabilities. Current liabilities have increased by $2,482 from March 31, 2025 to 2026, while other liabilities have decreased by $6,091 during the same period. In terms of interest expenses, a notable decrease has been recorded. For the 3 months ended 2025, interest expenses were $0 compared to -$124 in 2024, indicating a significant reduction. Similarly, for the 9 months ended 2025, interest expenses decreased from -$189 in 2024 to -$32 in 2025. These changes suggest that the company's financial obligations have become less burdensome over time. The company's performance can be analyzed through various segments and regions. On the positive side, employee-related expenses have seen a decrease, indicating cost savings of $3,823 in net stock compensation expenses for the 9-month period in 2025 and $3,743 for the full year 2025. Additionally, interest income has increased by $673 in the 3-month period and $1,943 in the 9-month period. However, there are regions that have underperformed. The Asia-Pacific (APAC) region saw a decline in revenue in both periods. Specifically, for the 3-month period in 2025, revenue decreased by $79, while for the 9-month period, it dropped by $217. These numbers indicate areas where the company needs to focus on improvement and strategic planning to boost performance in these regions. Management's outlook on the company is one of growth and value creation. They are focused on returning value to shareholders through share repurchases, while also investing in facilities and computer equipment to support business expansion. The company expects to generate sufficient taxable income in future years to realize its net deferred tax assets. In terms of strategy, management is prioritizing data privacy and ethics in its business activities, empowering marketers and media owners to deliver and measure marketing performance everywhere it matters. They believe that their subscription model provides insight into the long-term value of agreements and ability to retain and grow revenue from customers. The company has a strong capital return program with $1.3 billion in authorized share repurchases, indicating confidence in its financial position. Management is committed to investing in its business to support growth, while also managing market risk exposures. Overall, management's outlook suggests a focus on long-term value creation and sustainable growth. The company's financial activities have been notable in recent times. One significant development is the implementation of a modified common stock repurchase program, which has seen the company purchase a substantial number of shares. Specifically, it has bought back a total of 45.8 million shares for $1.2 billion. However, there is limited information available regarding dividend payments. Despite this lack of detail, one thing is clear. The company's focus on share repurchases suggests that it is prioritizing returning value to shareholders through other means. That concludes the financial summary for LiveRamp Holdings, Inc. Feel free to comment below, and I will be happy to answer them when possible.